Well, thanks very much for the great introduction. Until the last comment, I was thinking, boy, you know, everything ended in 2009, so it was what have you done for me lately? You know, by way of full disclosure, I should say that I actually got lost on the way to the building. I went to the south building instead, and I don't know if you know this, they're having a science conference there, and somebody said to me, Rosenberg, economics is an art, not a science. So you're going to the north building. Okay, thanks. Just show of hands, by the way. Anybody else an economist in the crowd who would dare to admit it? Okay, we have a game of bridge going. Any engineers or accountants? Okay, a lot more. Well, because I'm only saying that because you know this, you know the narrative, right, about there's the accountant and the engineer and the economist, and they're going for a job interview at a bank. And the accountant goes in and goes into the room, and the interviewer says, what's 2 plus 2? And the accountant takes out his calculator. It says 4. Oh, very good. Wait outside. The engineer comes in. Interviewer says, I'm going to answer the same question. What's 2 plus 2? Engineer takes out a slide rule. Says 4. Very good. Wait outside. Calls the economist in. Says to the economist, I'm going to ask you the same question I'm asking your two competitors for this job, which is this. What is 2 plus 2? The economist gets up from the chair, shuts the door, shuts the blinds, shuts the drapes, and he says, what do you want it to be? Anyway, that is, I'm not that guy. And I'm trying to get the slides going here. Going once, going twice. Are they locked and loaded? Sorry? In 2 minutes. Okay, so I'll do my Rodney Dangerfield routine. Well, I will say this much, okay, as they're getting it loaded. I want to address something that bothers me. You know, I got a Twitter account now, and so you can follow me on Twitter, and I had this little sort of quip. I won't say what it was, but it was, I thought, fairly humorous. And somebody actually said to me, because you know you read the trolls, and they said, "Hey, Perma Bear, didn't know you had a sense of humor." And I said, is that really my reputation as Perma Bear? Like, can anybody be Perma anything? But maybe I've been a Perma Bear. I've not been bullish enough on stocks. That much is true. But anybody that knows my work, they'll know that I've been very bullish on bonds. And I could have easily have titled this, and maybe my next title will be something a little less negative, and I'll just call it Bonds Have More Fun. And I might go with that. But you see, I actually been in the business long enough, and you know at the beginning of every year you have to come up with your shtick. And I realized after doing this for over 30 years that you can actually come up with your major theme for the year just by following the Chinese zodiac. So for those of you that saw me speak last year, the title was the year of the dog. The year of the dog, and the tagline was, will this dog bark or will this dog bite? And the dog I'm referring to is Jay Powell. And we found out last year as he hiked rates at every other meeting that he did bark and he did bite. And now he's whimpering under the weight of Donald Trump's tweet. I thought this year would be the year of the pig. Lipstick won't help. And the pig has really been this elevated and unprecedented level of uncertainty that we are living with right now. And this is not about risk. And people say to me all the time, well, it's a risky environment. Well, here's the deal. Invariably, it's always a risky investment environment. But the thing about risk is that you can price risk. Now, it might not be the price you want to pay, but you can price risk. Uncertainty, you can't price. Uncertainty is the classic Donald Rumsfeld unknown unknowns. So I'm going to be talking about that. I'm going to be talking about this year of the pig, because the thing we know about pigs is that their future is very uncertain. So if it weren't so sad, it'd be funny that we have this elevated uncertainty that Donald Trump is actually living up to his pledge to take on China. And what's very interesting is that China is not backing down. I think the assumption at the White House was that they were going to back down. But you see, we know that Donald Trump has unveiled 5 different rounds of tariffs, and Xi Jinping has responded 4 different times. So this is not just a global trade war. It actually, if you read the history of China and you read about their ascension and what their goals are, this is really an economic war. And this is the first time in our lives, certainly in the post-World War II period, that we've seen the U.S. economic hegemony challenged by another power. This is not the Cold War with the Soviet Union. That was a military threat. This is an economic threat. Lives won't be lost, but livelihoods could be lost if you're not positioned appropriately. By the way, I mentioned Donald Trump, Donald J. Trump. Did you see this, by the way, on PBS? It's the only thing I'll say about Trump, really. You see that? Saw the interview a couple of weeks ago? He was actually asked, what does the J stand for in Donald J. Trump? And he said, genius. So, see, I'm not a perma bear at all. I'm just a dentist with Novocaine. So there's actually indices out there that measure uncertainty, whether it's the number of times uncertainty is mentioned in CEO conference calls or in the survey data or newspaper clippings. There's actually an index that measures uncertainty around the world. And the answer to Donald J. Trump is that there are no winners in a trade war. And the level of uncertainty in both countries has never been as high as it is today. And in fact, the uncertainty has gone global. There's actually a global policy uncertainty index. And this chart really amazes me because when you think about it, the level of uncertainty today is higher than it was at the maximum point of the last 2 recessions, which are no walks through the park, even higher than it was in 9/11 or the financial collapse. So I say this with all deference to the fact that, yes, the stock market's hung in remarkably well, maybe because interest rates are so low. And maybe interest rates are so low for a bunch of other fundamental reasons that otherwise wouldn't make you so bullish on stocks. But we do know this much. We know we are in an unprecedented period of uncertainty. And we know that the Fed is looking at this very closely. Now, the Bank of Canada hasn't started cutting interest rates yet. I think they will very soon. But this report just came out earlier this month in the Federal Reserve that tried to estimate in a model how uncertainty is affecting economic behavior. Because we know that when you get more uncertain, you get more cautious, you save more, and you spend less. And there's nothing wrong with saving. But the problem is that when you're trying to forecast GDP, and remember people in the equity market here that earnings are part of GDP, when you save more and spend less because you're more uncertain, that has an impact on something very powerful called aggregate demand, and aggregate demand is GDP. And actually, just the uncertainty alone, and that's what Donald J. Trump has done. I don't know if he will make America great again, but he certainly has made uncertainty and volatility great again, is that the impact on global GDP has been a full percent of lost output. Surely you saw the newspapers today or yesterday that the OECD just again lowered its global GDP growth forecast for this year to 2.9%, which is the lowest growth. A year ago, they were looking for 3.6. That's a big haircut. 3.6 to 2.9, the lowest, by the way, since 2009. We were just coming off the depths of despair in the Great Recession. So when you're talking about the uncertainty alone, as you model it in this art called economics, 1% of global GDP, my friends, that is not chump change. That's like $800 billion of lost output. And we're seeing it in real hard data, not just soft data like uncertainty measures or survey measures. Global trade volumes, cross-border, exports, imports, and we're feeling it here at home too. Global trade flows have gone negative, and the most negative, once again, since the recession. That's not really normal in an expanding global economy. And then on top of that, we are seeing something else. Now, we can talk about what's the stock market thinking, but I'm telling you in the hard economic data, cross-border trade is contracting, and so is global industrial production. Okay, so people ask me, do we have a recession? Well, not yet, but it's coming, because the recession in the production sector, make no mistake, will have a lagged impact on the one part of the global economy that's still holding the glue together, which is the US consumer. And the slowdown in the economy globally is creating disinflation pressure. Producer prices are slowing down significantly. And again, that's very important if you're buying equities as an asset class, because this is no different than a chart of corporate profit growth. Corporate profit growth is slowing. Pricing power is subsiding. Now, if you believe somehow that the price earnings multiple will just continue to go up and up and up, and I want to load up more on stocks, well, that's fine. But what I'm telling you is that when the bulls tell you to focus on the fundamentals, the bears will say, exactly, because the fundamentals actually, for risk assets writ large, aren't that favorable. And in fact, what we do know, and these numbers just came out last week, which is the OECD leading indicator, the leading economic indicator for the world economy, has gone down now for 19 months in a row, even in the United States. Their leading indicator is down 13 months in a row, both to the lowest levels since 2009. Now, I find that a lot of economists can't seem to see past the tip of their nose. They're always talking to you about the coincident indicators, the lagging indicators. This is a leading indicator. This is telling you what's going to happen in the next 6 to 12 months. As weak as things are, they're going to be getting weaker. What are you going to do in your portfolio? Now, this chart is a classic economic nerdy chart, and it's called the output gap, which basically looks at where the economy is in terms of aggregate supply and aggregate demand. The output gap is the level of excess capacity in the global economy. When you're above zero, you got inflationary pressure, and you got demand growth far outstripping supply growth. Below the zero line, we have deflation pressure. And this chart actually, I think, has got to freak out every single central banker in the world, so far maybe except for Stephen Polo's, because we are 10 years into this expansion, that much is true, an expansion that was built on a house of straw, by the way, just more debt globally. First economic expansion ever where this output gap didn't close. This output gap didn't close. It's supposed to close an expansion, never did. And now that we know that the OECD leading indicator is down 19 months in a row, we're going back down, and deflationary pressures are going to escalate. And as I'll show you, that's why bonds and dividend-paying stocks, income orientation is going to be very important in a deflationary environment. We never closed that gap. You remember in 08 and 09 and 2010, all you heard from economists was deflation, deflation, deflation. But you see, at least in the last cycle, we closed the output gap, went into excess demand, and the peak in global inflation back then was 4%. We never closed the output gap this time around, and what was the peak in inflation this time around? 2% globally. So you're going to be hearing a lot more about deflationary pressure and what that means, especially for interest rates. On the left-hand side here is the S&P 500 in real terms, so adjusted for inflation. And yes, it's hovering near a high, but you know, it hasn't made a high in about 18 months. We're just flirting at the peak, but not making new peaks. I turn on CNBC in the morning, and all I hear Becky Quick say is, we're hanging in at the highs. Well, why would you put capital at risk in such a risky asset class just to hang out at the highs? Doesn't make sense. When I say bonds have more fun, and I'll talk more about that, look at the chart on the right, and that's in real terms, the total return index in the 10-year Treasury note. 10-year Treasuries have returned, by the way, 15% in the past year. 30-year Treasuries have returned 25%. The stock market on the left has returned 5% in the past 12 months. And what's helped has been the utilities, the telecoms, the pipelines, all the stuff that you want to own in a deflationary, weak economic environment. That's what I meant about bonds having more fun. And the same jokers who were saying a year ago How can you make any money? What idiot would buy a long bond at 3.25%? Well, because when you go down to 2%, the power of convexity. And what you want to do is go Google the word convexity and the interaction between prices and yields at these level of interest rates. Now, maybe if you're an insurance company or a pension fund and you have to have matching liabilities and assets, you've got to buy these 30-year bonds, but you can actually buy them and sell them. Nobody I know really buys 30-year bonds, depending on how many green bananas they have, to hold on for 30 years. But the reality is that a 3.25% coupon gave you a 25% total return because of the price appreciation. Only people in the bond market get that. I find people in the stock market can't do bond market math. But the bond market in the past year has actually killed the stock market, and I actually think that's going to continue. Now, I just want to go back here for 1 second. I said I was going to talk about Trump. I'm talking about Trump the genius. Look what he did. You see, because you can also forecast interest rates by the height of the central bank chairman, right? So what I'm wondering is that if he wanted a low interest rates person, why did he go for Jay Powell, who's 6 foot? Why did he not go for Arthur Laffer, who's 3 feet high? That way rates would be at 0 already. Okay, he missed his opportunity. But the one thing that we have to talk about the Fed is this. And this is the one area where I agree with the president. The Fed massively over-tightened this cycle. No other central bank around the world, including Polos, nobody, or Carney, or Draghi, well, nobody raised rates 9 times. And then the Fed did the quantitative tightening. I think they did it way too early. But when you look at the Fed funds rate on a balance sheet adjusted basis, you count on the quantitative tightening and you count in the actual 9 rate hikes, and you look at it over a cycle, so 3-year basis point change, the Fed de facto tightened policy this cycle. Of course, they cut the last couple of meetings. They tightened almost 400 basis points. And you can see whenever you do that, a recession is around the corner. The Fed over-tightened. Can the Fed stave off recession? Well, this was the chart that we had about Greenspan in April of 2001. Greenspan to the rescue. They already cut rates 150 basis points. And the recession started the month before, and nobody knew it. And the point I'll make is this. When people are cheering about the Fed tightening cycle is over and they're cutting rates, again, why are they cutting rates? Because of the economic tea leaves. The peak in the funds rate always takes place before the recession starts. A little bit of history. There's been 13 Fed rate hiking cycles in the post-World War II period. 10 landed the economy in recession. That gives me 80% odds. And in the 3 periods, the mid-60s, mid-80s, and mid-90s, when we actually just had a soft landing where you don't go into recession, but you slow down the automobile, those are more early cycle than late cycle. But this is telling you 80% chance. If somebody said to me, and invariably they do, what's your favorite economic indicator? What would you want on the desert island? A lot of people wish I was there. As my tool, it would be the yield curve. The interrelation between short-term interest rates and long-term interest rates, the yield curve. And the San Fran Fed did work on this, backing up my own work, which is that what they call the term spread, which is central bank lingo for the yield curve. Its ability to protect economic slowdowns appears intact. So the yield curve is relevant. That's on the left. When you invert, just one time during the internet era, during the dot-com in the late 1990s, the inverted yield curve, when short-term rates go above long-term rates, invariably you get a recession around the corner. And I throw in the unemployment rate because the St. Louis Fed also said that the bottom in unemployment occurs 9 months before the recession. And so you look at the unemployment rate, because people say, well, that's a lagging indicator. It's just an economic indicator. No. That's a great market indicator. It's a great contrary indicator. It's why they call economics a dismal science. Look at that chart on the right. Do you want to go long the market at the lows? Or do you want to go long the market at the highs in unemployment? Because at the highs, you have this whole runway, multi-year runway for growth, lots of excess capacity. But we're not there. And you can see for yourself that just like the yield curve, when you're the lows in unemployment, the recession is right around the corner. And in fact, the New York Fed does the work for us to some extent. They run a recession risk model, and recession risks right now, you can see for yourself, are running at over 80%, just as they were before the last 3 recessions. So I'm not going to say it's 100%, but once you cross 80, there's no turning back. And even if you don't agree with this, you say, I'm going to wait for it to get to 100. Good luck with that. because it never does. But at the start of the year, the odds were 50%. A year ago, they were 20%. So the message I'm going to make is this. You got to adjust your portfolio in line with rising recession risks, even if you don't believe a recession's around the corner. I think it is. And here's what happens in a recession. At the very bottom, the stock market usually peaks 7 months before the recession starts, because it's a leading indicator. The stock market's down 10%. In the recession, it's down 21%. And in a recession, bear market, the stock market's down 30%. I think this is actually just starting. And 10-year bond yields go down 160 basis points. So when people say to me, we're going to new lows, yes, we're going to new lows on bond yields. And for people that like to look at it graphically, you'll see on the left-hand side, the stock market peaks before the recession, goes down, bottoms before the recession ends, because it's a leading indicator, and bond yields do the exact same thing. And the recession hasn't even started yet. It's about to start. And here is exactly how you want to be invested. You want to fade the stuff on the left. You heard a lot about ETFs. Well, you don't want to buy index ETFs. You could buy sector ETFs. You can see for yourself that the era of passive investing is over. Do not buy the indices. Look at emerging markets. I get this all the time. Emerging markets. Do I buy emerging markets? No. No. You want to have liquidity on hand. Emerging markets, remember, are markets that you cannot emerge from in an emergency. And so emerging markets no, the headline indices no, the Canadian dollar no, commodities no, high yield bonds no, but the stuff on the right works in a recession. So no, you don't have to go out and buy barbed wire, sawed-off shotguns, baked beans, spam. What you want to do is you want to have a core holding of high-quality bonds, government and corporates. Not just government, but corporates. Pick up a spread, but be mindful of their balance sheet strength. Be mindful of their refinancing risks, but you want to own high-quality corporates. You want to own long government bonds. The dividend stocks will do just fine. The pipelines, the REITs, the utilities, the stuff that's worked will continue to work and for the right reason. Have some cash on hand. I should say that gold does hold its value. I'm very bullish on gold, by the way. Very bullish on gold. Gold is in a long-term bull market, and I would add that to this portfolio and find a way to capture volatility. Buy the VIX while it's cheap. In any event, folks, I think that my time is up. Okay, so thanks for indulging me. Best of luck.